Hi, good afternoon. You're watching Closing Trades on ET now, and for now there's red on the screen, so that initial bounce that we had seen at open has been sold into. In fact, during the trading session, Nifty went below the mark of 24,000, so quite a bit of dropping is what we saw in the trading session. While on the other hand, the India VIX had surged very close to the level of around 15 thereabouts. So there's definitely the volatility which is creeping back into the markets. Bank Nifty, that one has seen quite a bit of bruising today. That index, when I last checked, was down over 1% in the trading session, a cut of over 600 points on that one. It's HDFC Bank as well as SBI, which are the biggest pain points for the markets. In fact, if you look at the frontline index, they're contributing almost 70 points to the downside overall when it comes to the Nifty. So clearly pain coming in, and HDFC Bank taking it on the chin right now. What's holding better than the rest of the market is IT clearly. So whether it's L&T Tech on account of that acquisition news, LTI Mindtree, HCL Tech, Coforge, these are some of the names which are in the green. So only IT and maybe a couple of these FMCG names led by Jubilant are in the green. But the rest of the market, Aisha, is firmly in the red. And clearly no major buying on dips which is emerging on a very sustainable basis.
Oh yeah, absolutely. And you could today blame it on the kind of global sentiment as well, which is prevalent. Look at how Europe has started, and I was just looking at that. Markets like DAX are seeing a cut of about 200 points. It's a 1% slide for FTSE as well. Almost a 100-point knock coming in for the CAC. Even broader markets like Stock 600 and FTSE MIB are knocking down about almost 1% or so. The fresh earnings and inflation data is what the street has been digesting. Just want to mark what the pre-market rates for the US as well are looking like. A more sedate move there for both the S&P, the Dow, as well as the Nasdaq after hitting fresh record highs just overnight. So yeah, seems like the FI selling, which at least had sort of reduced in quantum. Maybe today's number is going to be a little bit largish, because even Asia flipped off towards closing. Look at Hong Kong, that's seen a crack of nearly 600 points. That's equating to about a 3% cut. Shanghai knocked down about 1.5%. Japan also, one of the markets which has actually been seeing a lot of money inflow towards it. 150 points knock coming in there as well. So clearly that post-Trump rally seems to be somewhat fizzling off, and global markets as well are shaking off that excessive froth that we've seen of late. But a lot of stocks as well to talk about. You've of course got Britannia, which is reacting to its numbers, the kind of management commentary as well that we saw on Britannia. You've seen Asian Paints, which continues to see a sell-off from yesterday. Trent continues to hold on to the gains post the upgrades that trickled in. But largely today there are also other blue chips. Look at an HDFC Bank that's down almost 2.5%, so weighing heavy extremely on the index. SBI is down 2.25%. There's Tata Motors, which is down. Maruti, which is also facing the heat today. There's a Kotak Bank, Axis, M&M. The blue chips definitely are weighing heavy on the markets as we speak. Reliance, though, just about scratching the surface in the green, but yeah, in the green nonetheless. But let's pick up the discussion forward. We've got Andrew Holland joining in on the show right now, Naresh Mirani as well on the charts. Andrew, hi, afternoon. Let me begin the conversation with you. What's really spooking the global markets right now? Do you think the excesses of the Trump rally getting shaken off a little bit today?
Yeah, I mean, you're bound to see a little bit of, slowdown in the index from its rise. But, one thing that has clearly happened is that all the attention and all the focus is now on the US, and that's what we've seen in terms of the markets, not just the equity market, but obviously the currency and to some extent, crypto as well. So I don't see that stopping. I think that's going to be the kind of theme as Trump puts together his administration, and America first kind of comes out of this. I think the bad news is that, for emerging markets, any kind of passive flows which might have come are going to be directed towards, developed markets, but particularly the US. So I think there's too many kind of uncertainties for emerging markets up until after the 20th of January. Of course, tariffs is one of them. But it really is, what will countries do about it? We're seeing the Chinese already depreciating the currency. That's going to have knock-on effects for other emerging market currencies, including ours. So all the things that we're holding there a kind of unfolding. And one of the things that we were hoping for, and we talked about this before, was that, the interest rate regime might kind of, trickle through to India. But again, with thoughts about tariffs possibly kind of increasing inflation in the short term, the Fed may well go on hold in December, which means that, the kind of expectation that we had of a rate cut here might kind of be pushed well into 2025, which is not great for our markets and particularly the kind of financials. So those are the tailwinds which have been taken away from us. And the earnings season, I'm sure you've talked about it quite a lot anyway, has been particularly poor. But what's more concerning is that both the revenue line and, more importantly, margins across sectors have really taken a beating, and I'm not sure how they're going to improve from here in the very short term.
Indeed, as far as the earnings season is concerned, but the one space which is holding out today is real estate. Naresh, what's the sense on that? Macro tech developers is doing quite well in the trading session. Phoenix Limited, Brigade, Raymond, they clearly are the outliers in an otherwise weak market.
So we are seeing some little bit of a bounce, given that some names have corrected. So, for example, a Brigade has corrected from 1450 down to 1100. So in that sense, we are seeing some bit of a bounce. Same is the case with the macro tech, down from 1650 to 1180, etc. So in that case, expecting some bit of a bounce back. But overall, till the time we don't see a reversal in FII flows, we continue to face pressures.
I believe till the time we don't see the reversal in FII flow, this underperformance of HDFC Bank will continue? Andrew, the question is for you on HDFC Bank's underperformance.
Yeah, I don't think it's necessarily just HDFC Bank. I think it's the whole banking sector which will be under pressure from FII selling, given its weightage in the index and given its weightage in portfolios. So, if anything, it's kind of held reasonably okay for the past month, and so that's maybe why you're seeing a bit more selling pressure there today. From where it was before. So I don't think it's any bank in particular. I think it's the whole sector, given that the headwinds in terms of rates might not be reduced as quickly, and the slowing economy doesn't bode well for the banking sector, given the problems they have with interest margins as well. So it's just not an easy place to hide at the moment in the Indian market.
Are you saying stay away from banking names and don't invest in them at the moment?
I think for the, if I'm a retail investor, I think I would just take whatever I would have, sit on the sidelines with some cash and just wait. I mean, there's a lot of, kind of news flows which are going to happen over the next 1 month. And it's just, it's worth waiting to see how some of that might play out, because, for all what we talked about tariffs, personal tax rate reductions, corporate rate reductions in the US. We still have to wait for President Trump for him to take office. And maybe things might not be, turn out the way that everyone's expecting at the moment. So I think it's just worth just sitting there a little bit and just saying, okay, I can wait through this and then deploy as soon as I see what is happening in terms of some of those policies playing out, and how likely that's going to affect India in the kind of in the short term, not necessarily from an economic viewpoint, but more so from a flow to emerging markets viewpoint.
Right, and that's quite interesting, Andrew. So curious to know, what is it that you would be deploying that cash for whenever the next wave of the dip comes in the market in the next month or so, like you were just highlighting? Anything that's looking interesting or emerging as a winner after the recent spate of correction in the market?
I mean, it's not as though there's no winners in going forward, but I think when valuations are still as high, everything gets tarred with the same brush, no matter which sector. So you might get relative outperformance, but at this point, I would say that just keeping your powder dry is probably the best thing to do until some of these scenarios play out to a point where you can say, okay, for example, if you know when Trump gets in, if he brokers a deal in the Middle East and Russia Ukraine, that would probably mean obviously the oil price would fall. But you know, would then countries be so adamant in terms of increasing their defense spending? So a lot of these things, you know, I think are unknown. And I think it's just worth just sitting there and say, okay, I'll wait for that. I can wait to see what's going to happen and then take my view.
Right. Okay, interesting. That's the take coming in on what is it that can be bought once the weakness in the market kind of ebbs off. But for now, of course, it's some of the key heavyweights. HDFC Bank weighing heavy. In fact, now it's counting down to almost a 3% decline. And given the maximum weightage that it cherishes on the index, that's surely weighing down heavy. SBI is well lower by a good 2.25%. Bajaj Finance is down about almost 2% or so. Axis as well is seeing a red tick of about almost 1%. So not really seeing much, strength at all, in fact, across the banking pack. What's holding out still in the green, a couple of these technology names, and it's not quite the picture as was the case yesterday, but relatively so, they've managed to withstand the market fall. So HCL Technologies, Infosys, TCS holding on to their greens. Reliance making a bit of a dead cat bounce after the relentless selling that the stock has seen of late. ONGC and Trent are the ones which are actually holding up. Naresh, you think the selling in Trent post the earnings is done with? Because yesterday and today the stock has been holding up.
So the stock has corrected from 8,400 all the way down to 6,300. A little bit of a bounce would be normal. But closer to 6,800 to 7,000 would be a stiff resistance. So going forward, that's a zone where it will continue to face resistance. On the lower end, 6,000 is the last breakout point. So I would expect it gets into a range going forward rather than a strong bounce.
That's the take coming in on Trent. A bit of a bounce back coming in, but time now to head into a very short break. Don't go anywhere. Lots lined up when we come back.
Back with closing trades, Rathi and 80 now, and haven't seen any resurrection. In fact, if anything, you may want to check in on how Asia shut shop and now how Europe as well is bleeding. 1% cuts coming in across the board pretty much. Not quite rubbing off on the US futures just yet, but again, early days. Let's see how much of the Trump rally actually has more legs to it or not. For now, of course, it's single-handedly HDFC Bank, names like Asian Paints, SBI, Bajaj Finance. They're the ones which are really weighing heavy on the indexes. CA Rudramurthy on the show with us. Rudra, hi, afternoon. Good to have you on the show. Just wanted to take on the Nifty Bank because, HDFC Bank and SBI clearly are one of the biggest contributors to the drag on the index today.
Yeah, good afternoon. Thanks for having me in the show. And definitely today's fall has been more steeper and crucial supports have already got broken both in Nifty as well as Bank Nifty. So for me, this selling today clearly indicates that it is just a matter of time. The previous recent lows of around 23,800 in Nifty and Bank Nifty at around 50,500 will get again tested, and breaking that is a higher probability. So for me, this market is surely a sell on rise market for very short term. Yes, medium to longer time frame investors have to wait out for that great opportunity to buy stocks at a much lower level. But for me, both Nifty and Bank Nifty are sell on rise, and 23,800 is the last support left for Nifty. And it is just a matter of time, even that will get broken. Seeing the selling today, I'm definitely not happy. It was only Reliance which was pulling the markets down earlier, but now even banks have joined into that selling party. You can see HDFC Bank, SBI, in spite of good numbers, falling today over 2%, and HDFC falling close to 2.5–3% is not a good sign. So for me, it is a wait and watch for long-term investors, and for short-term traders, it's a sell on rise market.
Sell on rise kind of market, not liking the texture at all. But Andrew wanted a better sense with respect to consumption. Earnings season, of course, clearly hasn't been good, but the commentary regarding second half also hasn't been that optimistic. And that's clearly showing in the YTD figures, where Tata Consumer stock is down 11% for the year, Dabur is down 8%, HUL is down 8%, Britannia is down 5%, and a lot of these FMCG companies haven't delivered any returns if you look at 12 to 18-month performance. Is it the time to perhaps buy some of these names that they're, getting closer to the bottom? Or there is a couple more quarters of pain left in these?
To pick on one sector, it's okay, but I would say that this is a trend which you're going to see across all sectors, because I'm just not seeing the catalyst for earnings to move higher. If I think about government spending, I'll come back to FMCG, but government spending really has to take off, and private capex as well, which is just not happening. So, that has a multiplier effect across different industries and the economy. So that's not picking up. As regards FMCG, well, the commentary, as you said, is poor, right? I mean, they're saying urban consumption is starting to slow, and there's not enough pickup in the rural economy for that to kind of make up the difference. So we go back to volumes are not there, margins are under pressure, and that will continue. So I say there's nowhere to. I'm saying there's nowhere to hide at the moment. I mean, IT is one place which is doing well, but that's really on the back of what's going to happen globally. If the US cuts corporate tax, then that's obviously the kicker for the IT sector, in terms of that's where the narrative is at the moment. So otherwise, for the rest of the sectors, it's more more concentrated in India, which most of them are obviously. It's going to be tough work to get your volumes and your margins higher from this point on. So again, I go back to just sitting on the sidelines isn't a bad thing to do. These ratings anyway were very high, and there's probably more kind of PE compression to come until earnings start to kind of pick up. Not just for FMCG, but for other sectors. So you've got to look closely of where the growth is going to come from. I still think, hospitality, people traveling, I still think that will be a key feature, at least for the next year or so. And there's obviously not great, a lot of supply coming on in the hotel sector, for example. Airlines look okay. And I think, the kind of premiumization is happening, but it's happening in pockets. So, alcoholic and non-alcoholic drinks are the place to be there. And finally, electronic manufacturing, because if India is going to do that China plus one, then electronic manufacturing, I think, is still a great area to be in the long term. So those are three themes I'm playing. But if markets go down, then these stocks go down with them.
Yeah, although some of them have barely gone down. Case in point being the stock that we were just flashing, that's Kane Industries as well. In the meantime, let's just see what else is happening in the market right now. Trent continues to hold out. ONGC, HCL Technologies, Infosys, Sun Pharma, and Reliance surprisingly seeing a little bit of a bounce. TCS, ICICI Bank flattish right now in trade. Indocent, Titan, Hero MotoCorp, they're just at best relative outperformers, or at least resilient to the rest of the market. BEL, HDFC Bank, Britannia, SBI, Tata Motors, they continue to see a fall. Naresh, just wanted your sense on the entire auto pack, and when do you think names like a Tata Motors, Maruti, which have been sort of weighing heavy and more so after their earnings, when do they see a meaningful bounce come in, or at least some consolidation?
So for now, the trend is pretty weak across the board. And given the extent of the rally, so if you look at Tata Motors, the stock went from 400, 450 levels in 2023 all the way to 1150. Out here, a major support for the stock comes closer to that 750 mark. From that price point, I would expect some bit of a bounce back or a short-term bottom to be in place. Maruti, on the other hand, 10,000 remains a very important support, 10,000, 10,500. That's where it all started from. For now, in the near term, 11,000 has been acting as a support. But the trend is still tough to see a stronger recovery in auto names, given that in the last 2 years, they had gone up 100 to 200%. And a 20% correction from the top, and then a consolidation for a few weeks or months would be normal. So I think in some cases, we get into a further correction. In some cases, we get into a consolidation. But a strong rally does not look a probability in the near term.
The take coming in, a strong pullback doesn't seem in on the cards as far as the auto stocks is concerned. Andrew, we'll let you go on that note. Thanks so much for making time and speaking with us. A couple of these urban consumption names are in focus. Jubilant Foodwork has been doing well since the start of the trading session. We are expecting numbers for Nykaa to come by very shortly, and we'll get Snehi to join us to talk to us about the expectation. But talking about the BPC category, Shoppers Stop has been making inroads in that space, and my colleague Asta Chopra caught up with the management at Shoppers Stop. Hear out what they have to say about the way forward.
We have just opened the first Armani boutique in New Delhi at Promenade Mall last week. We will have 2 more boutiques that will come up, one in Mall of Asia very soon and another one in Jewel Drive in
the
Mumbai.
Armani one.
Armani Beauty Boutique.
Beauty boutique.
So if you think about it, this is the moment people have been waiting to celebrate.
Yeah.
And these are amazing and iconic brand. We will also have a Prada boutique that will come up soon. So technically, we already have a NARS boutique which is there in Select City. We'll have a few more coming up. So to your point, I think this is a great moment for all the discerning Indian consumers who have been wanting to shop beauty in their home ground. So I think we feel extremely privileged to be part of this journey, and we think that this is just the beginning of many more partnerships to come.
So, Biju, one thing I want to understand, like there are many e-commerce platforms, everyone is talking about that. Beauty products are being sold there also. But the traditional way of purchasing the beauty, feel in touch, matching the colors and everything. So I want to know that many of the industries are suffering from the e-commerce because the traditional one is not doing better. What is your deal with that? How is the Shoppers Stop being impacted in a good way or a bad way? Are you looking for any collaborations with e-commerce business? How is that for the business, as well as what preference do you see in consumers, that whether they want to come and feel or they are like switching towards the e-commerce, the comfort zone?
So I think traditional and e-commerce is here to stay. While we know that quick commerce is the new disruptor, I think an omni approach is what is critical. To be an omni-channel player is a compulsion, because you are playing with the engagement along with the convenience, which means that we are technically blending both together. Yeah. So, for example, people browse and they research a lot on e-commerce, and sometimes they buy there, sometimes they come back to try the products, get satisfaction in terms of what he or she was looking at, and then buy at the brick and mortar. Similarly, people come look at brick and mortar, they come, they see, they like the fragrances, and they probably go and buy at e-com. So I think it is a seamless journey. So at Shoppers Stop, the strategy is very clear. We want to be a pure omni-channel player.
BPC clearly making a lot of inroads, and the company is looking at tapping into that. Talking about BPC, as we pointed out, Nykaa will come out with its earnings today. Snehi is joining us with the key expectations.
Well, yes, we're expecting a good set of numbers from Nykaa for Q2. If you take a look at the numbers on a consolidated year-on-year basis, here's what we're expecting. On the revenue front, we're seeing that figure at 1,887 crores compared to 1,507 crores, which is an uptick of roughly 25% on year-on-year basis. EBITDA, we're expecting that figure to go up by 42.4% at 114.8 crores this time. Net profit, however, we're expecting a big jump on this front, coming in at 24.7 crores compared to just 5.84 crore rupees last year, which is an uptick of more than four times on a year-on-year basis. And EBITDA margin also, we're expecting that to expand at 6.3% compared to 5.4% last year. Some key expectations then, we expect the BPC segment, which is the beauty and personal care segment, top line to grow at 30%. The fashion segment top line is expected to grow at 25%, and the operating leverage in BPC and the lower losses in the fashion segment are expected to drive margin expansion this time around. Now, what we'll be watching out for when the earnings come out, the BPC segment, the advertising revenue of that segment and the EBITDA margin improvement is something that we'll be keeping a close eye on. BPC new customer addition will also be important to watch out for, and on the fashion segment, the net sales value growth and the loss reduction are going to be important metrics to watch out for. But well, yes, overall we're expecting a good set of numbers from Nykaa for Q2.
Okay, a good set from Nykaa. Let's see whether that can fill up the stock or not. For now, we're going to take a very quick break, come right back. We'll continue tracking markets on the other side.
Welcome back. Well, the pressure continues even though we are off the lowest point of the trading session. There are select names like Britannia, BASF India, Akums Drugs, which are down in the trading session, Whirlpool, Piramal Pharma. They're all seeing cuts of anywhere between 6 to 14% at the moment. So individual pockets which are under pressure. But the overall market setup, what do we make of it and what do the experts have to say about the same? In fact, my colleague Anurag Shah caught up with Saurav Mukherjee of Marcellus Investment Managers. Hear out his take on the market and India growth story.
Using the government data, right? Using the government data on individual income tax returns, it's pretty clear that what we've been able to create successfully in India is a class of super rich people. So individuals with income of 1 crore and more, right? Individuals reporting income of 1 crore and more. 10 years ago, unki ginti 40,000 thi, 40,000 10 years ago. That number is now 2,20,000. So kariban 6x jump in the number of individuals reporting income of 1 crore or more, right? That's what I mean by the elite class. And in the book, in Behold the Leviathan, we've explained that even if you look at corporate tax data, a similar bifurcation is evident between a class of elite companies, करीबन 70,000 elite companies, करीबन 2,20,000 elite families. These are the people who are rocking in India. They're making a lot of money, the businesses are blossoming, they're making money in the stock market, real estate, so on and so forth, right? In parallel, the challenge for the middle classes has been that automation in offices, in banks, in IT services, in factories, automation has taken away a lot of the middle class jobs, and whatever is left of middle class jobs, bargaining power for the middle class has come down. That's obviously had a bearing. Jobs bhi kam hai, bargaining power bhi kam hai. That's had a bearing on middle class earnings, which is why we are seeing the consumption downturn in categories which are middle class centric. Just
Okay, that's sort of Mukherjee trying to understand and talk about the consumer construct right now and why is it that the premium segment has been doing all that well. In fact, it's also a continuation of the latest wealth index report, which was unveiled by 361 Wealth and CRISIL as well, which actually shows the key trends in the investment choices of wealthy investors. There's clearly growing popularity for alternate investments, including unlisted equity, real estate. More wealthy investors are also seeking to consider ESG investing. In fact, we caught up with Karan Bhagat as well, the CEO and MD at 361. Let's hear out what he had to say.
Well, I think our role as a wealth manager to the client is very, very clear. I think we are an open architecture advisory firm. So really the first job we have as a wealth manager is to create what we call as an investment policy statement for the client. So the investment policy statement is a statement which rightly captures his objectives. It captures his desires, his goals. What kind of liquidity can he tolerate? What kind of volatility can he tolerate? What is the periodic review his portfolio should be conducted with? And most importantly, even from our side, who is the team? What is the review mechanism of his portfolio? I think the starting point is building out this investment policy statement. And once the investment policy statement is built out, then we need to build an engagement model, okay, which is devoid of conflict of interest. Some clients would like us to be paid by the product manufacturer. Most clients would want us to be receiving a fee from them and invest everything in a direct plan. All of these things really get defined extremely well, and some of them have different entities, private limited entities, individuals. So understanding the structure behind all of these entities. So all of these three things get captured in the investment policy statement, and that really serves as a base document for us to be engaging with the client for a long period of time.
Okay, so that's Karan Bhagat of 361 talking about how the entire wealth management services are panning out and what really clients are looking for right now. Important to get the perspective with the kind of market setup that we have at our hands. In fact, the Nifty now at the lowest point of the trading session, now even threatening to go below the mark of 23,900. So the pressure continues to deepen for the markets at this point of time. Pashupati Advani also joins us on the show right now. Pashupati, what you're doing? Are you looking at buying into these dips, at least in certain stocks and certain pockets, or just sitting on the sidelines for now?
I'm actually still a little nervous because I think that there are some things that are going to affect India going forward, and the thing is the FI selling is still not stopped. So we are seeing good names come cheaper. So as long as it's continuing to go, when you have large caps falling by 1.5–2%, that means that the blood is still out there. So I'm still a little cautious. I think once it settles down and then turns, then one can take a look at maybe buying again. If it's up, maybe 3-4% off the lows. But still, it seems to be going down.
And just wondering, Pashupati, what is it that you've got your eyes on? What is it that you would be buying or at least have on your radar? Should it fall further, you'd buy?
No, I think you're getting the opportunity to buy big stocks. So, I mean, one can look at things like Reliance. HDFC Bank has jumped up a little bit, but it probably is attractive when it comes back into the 1600s. Some pharma stocks that I like, they will also do well. Maybe things like Asian Paints, some of the Tata companies, the big blue chips, because they're the ones who seem to have fallen off. And that's what's actually pulling the Nifty and the Sensex down. So I think you're going to have an opportunity to get in. I still think there's a bit of time for this because it's still not settled, because every day we're still seeing negative figures from the foreign investors. And until that stops for 2-3 days, I would not jump into the water with my head first, if you know what I mean.
Yes, we do, absolutely. But the FII selling hasn't really turned as of now. So yes, it's better perhaps to sit on the sidelines. But Pashupati, will you be sitting on the sidelines come tomorrow when Swiggy lists on the bourses? For now, the expectation is it's going to be a muted one. But if you're a long-term investor, would you just dive into that one or again staying away?
So, what's happened is we've had 3 or 4 large IPOs. Apart from Swiggy, we've had Hyundai last week. And, that also takes money out of the market. And at the end of it all, we're a market that runs on supply and demand. So I think that what's happening is that because you've had these large IPOs suck money out of retail as well as wholesale money, it is causing a bit of a damper. And, normally when you look at new issues and you look at them a year later, hardly 3-4 of, maybe 15% are up and 85% are down. So let's hope that Swiggy is one of the ones that is going to be down, because long term, I think Swiggy is great.
Okay, so long-term Swiggy is still better. We'll try and get those graphics up for you on the screen with respect to the overall allocation that we had seen. It was a good subscription when it comes to the institution part. But if you look at the retail participation, it was just around 2 times in terms of the subscription that had come through. But just taking stock of some of the other buzzers, and from the pharma space, there are names which are actually holding out. A couple of names which will, like Eris Life Sciences, Fortis Healthcare, etc. Rainbow Children's is up and about. Rudramurthy, any names within pharma that you're looking at buying as yet, or again staying away from that space as well?
See, Aisha, for me, yes, 2 sectors where you can hide in this fall will be 1 IT and 2 it will be select pharma. But still for me, this market has still not bottomed, and I fully agree with Pashupati. The only number 1 factor you can make it easy to call this market bottom is to see the FII selling. If I'm not wrong, even yesterday 2,300 crore of FII net selling was seen in cash market. And overall, for just a month's time, they have sold over 1,30,000 crore. So for me, this FII selling has to stop. We have to see at least some amount of buying from FIIs, at least for 2 consecutive days. And then one can conclude that yes, the bottom has got formed, or one can look at cherry picking. Or else in general, this market is definitely a sell on rise for very short term. Wait at least for some amount of FII buying to emerge in this market. And if you are still a very prima bull and you want to buy this market, then look at sectors like IT, where stocks like Wipro, or even for that matter TCS, Infosys, any of these stocks look good for me. As a sector, IT can be that hiding place. And you can also look at pharma. Yes, stocks for me like mid-cap pharma, and especially stocks like Laurus Lab, or something to do with stocks like Granules, Fortis Healthcare. So these are some of the stocks where you can definitely be very selective in pharma and hide in this fall. So IT and pharma will be the 2 sector in general one can definitely buy if you are a bull, and wait out for FIIs to turn out bullish and let them turn out net buyers. Till then, I will definitely avoid buying in any other sector in general.
Right, okay, avoiding right now buying anything in individual sectors for the slightly medium term. Still in the red, it's resurrected a little bit. 260 points lower is where we're currently at. Not resurrected, I stand corrected. We're still down a good 1.5% from the top of the day. Britannia, that's the one which is really bleeding. It's down about almost 8%. It's almost looking like the Asian Paints move from yesterday. The management has said that there are going to be another 4 to 5% kind of price hikes in the next 2 quarters. They're saying that they will be executing the price hikes by December, Jan. They do expect some short-term volatility or impact on volumes as well. And they are gaining market share, however, in the QCOM as well as the e-commerce as well as modern trade instruments. They're saying rural is now inching towards a double-digit growth, starting to look better, hoping for the recovery to continue. And they do expect to maintain margins going forward as well. But still, it's quite a bit of bloodbath on Britannia. And mind you, this stock also went in weak into its numbers. Yesterday too, it took a knock of about, I think, 4 to 5% if I'm not mistaken. In fact, let's hear out what the management had to say on their conference call.
There will be about 4 to 5% price increase in the next 2 quarters. So that we'll have to take. And we will do it strategically in SKUs where we haven't taken a price for some time. But if we have to take 4 to 5% on our entire portfolio, it tends to hit the large SKUs and large brands. So we are in the process of doing that. It will be gradual, but yes, wherever we can, the price increases are. If it's a direct price increase, it'll be taken right away. But I would say December, Jan, we'll be done. We've been seeing very good growth as far as quick commerce and e-commerce is concerned. Even modern trade has been doing reasonably well, although the competitive scenario there is pretty tough. But we've been doing well and we've been gaining share in both quick commerce, e-commerce, as well as modern trade. Rural's coming back slowly. So as rural, starts to come back to the kind of double-digit growth that we were seeing in the past, I think we should be in a good place. See, rural is doing better. Rural was doing worse than urban till about 2 quarters ago. So it's doing better, but still it's in mid-single-digit kind of growth for FMCG. So that's not what it used to be, let's say, 4 quarters or 8 quarters ago. For us, we were growing high double digits as far as rural was concerned. So it will come back. I think it's starting to look much better, and we are hoping that things will get better with, the rural economy continuing to do better than expected. So we expect to maintain margins rather than increase margins, balance inflation, and make sure that we are able to keep a stable margin profile. The rural growths are reasonable. I would say slightly high single-digit kind of growth.
If you look at H1, we've ended up at about 18.5. So we are still within the overall guidance which is there. The attempt is that in the coming quarter, definitely the full impact of the price increase we have taken will come in. And we are hoping that if there is definitely some stability in the crude prices and we see some amount of deflation, I think we would definitely aim that we are in that band for H2 as well as we kind of go forward. When we look at H2, quarter 3 is, as I said earlier, looking a little bit challenging in terms of the overall numbers. We'll have to see how it pans out. But I think overall, as we go into quarter 4, we should see definitely some improvement happening. Based on that, I think we should kind of really maintain, single-digit volume growth numbers for the year.
Still confident about growth going forward, though they're talking about single-digit growth when it comes to volumes instead of double-digit that they had pointed out earlier, and clearly competition heating up in the space. Pashupati, what's the take on urban consumption, paints for instance, despite those pre-sales numbers and the real estate numbers picking up? Clearly the competition is something which is impacting companies like Asian Paints.
Well, Asian Paints has been the market leader, and there are now 4 or 5 strong players who've come into the space. So obviously, it's going to create some. You can always only go down, and we've got real deep-pocketed players that have decided to come in, like Mahindra's, like Jindal's. They've all decided to come into the space. So it's going to be interesting times. All I can tell you is that I'm looking forward to getting better quality paints to be able to paint my house. So I think it's better for the customer, and it's great for all of us.
And clearly, are you looking at ordering some better food from Jubilant as well? Because the Domino's business has managed to bounce back. Is it you who's been ordering more pizzas?
It's not that. I believe I read somewhere that Domino's delivers pizza in 9 minutes or 10 minutes. I don't know how, but they do. But I don't know.
Could be, but from what I recall, when we last used to have Domino's, and that was one of those first people who would deliver 30-minute delivery, right? And they would give you the pizza free otherwise. Yeah.
9 to 10 minutes is something of a revolution, if I can say, in the industry. A quick commerce kind feeling. But please go on, Pashupati. You were making that point regarding urban consumption.
I was also making the point that what is going to happen with the advent of, people like Swiggy and Zomato also going in for the delivery business. It's becoming cutthroat. The QSR business, which is the organized food delivery business, seems to be growing. There seems to be interest in investing in those kinds of companies with new brands, with existing investment to these brands. So I think that, that's the next phase, because it's becoming an official market from the unofficial market. And you're getting cloud kitchens and food versus the old days where people would just make food and send it to you. So that is a subtle transformation that's happening, and it comes with people earning more in their pockets. So I think that's definitely we are following the rest of the world in that.
That's that coming in on Jubilant FoodWorks. In the meantime, just taking stock of some of the other names, we're down a good 350 odd points from the day's highs, by the way. Not to say that the day's highs were anything fantastical. We started off very muted and marginally higher. From there, of course, we've slid quite a fair bit, even breached the crucial 23,900 mark as well. But Naresh, what kind of downside does it now open for the index? And do you see a further continuation of selling now that we've breached 23,900 once again?
So the recent low, we are almost there in terms of breaking. The next major price point for the Nifty is closer to the 23,400, 500 mark. Now, that is why is that important? That is the price point we roughly saw on the day of opinion polls. That's the high we saw. And post that, that was also a point of time where we roughly used to get some resistance and saw a little bit of a consolidation. So 23,250, 23,400, 23,500 is the next price point. Also at that point of time, we get a good correction also done from 26,200. So we'll be watching out for that price point going forward. And on the upside, once we start crossing 24,300 to 500, then it becomes a trend change. So for now, this becomes a 1,000-pointer range, which is a little large for the near term.
Yes, the selling is clearly intensifying when it comes to the market. Sensex almost a 1,000-point cut at the moment. The frontline index seeing quite a bit of dropping, almost a 300-point slide coming in. Not sure if you're missing any news flow as such, because there hasn't been anything incremental during the trading session which would sour the sentiment per se. Yes, the global markets could be attributed regarding one of the reasons of the same, but the Bank Nifty is down 700 points. HDFC Bank is seeing quite a bit of selling pressure. SBI is down, PNB is down. So clearly, the market not willing to give a benefit of doubt at the moment, at least with respect to how earnings have panned out and how valuations are stacking up. In fact, on the losing side, apart from Britannia and Whirlpool, there's also Pharma, Bosch, GE Shipping. All of these stocks are coming under quite a bit of pressure at this point of time. What do you mind, Pashupati, will turn the tide for the Indian markets? Because as we usually say, it's, towards the year end, FI flow and FI activity already ebbs because of the holidays, etc. Earnings we have seen, they've come and gone, election has come and gone, Fed decision has been done with, RBI largely we know the way forward. What then will turn the tide perhaps?
I think markets globally are going to settle at a slightly lower level. One of the things is that I know the Fed cut rates by a quarter, but I actually see it very difficult for them to cut rates further, at least for the next 3 to 4 months. And I know because in any case, Donald Trump doesn't come into the White House until January. So I think for the next 3 to 4 months, there's going to be no cuts. Even when he gets into the White House, it's going to be tough for him to cut rates. And as long as rates are where they are, plus the Japan carry trade has gone, all of a sudden, it's, there's no real reason, to stimulate the markets. And of course, we're seeing selling from FIIs because the Japan carry trade is also vanishing. And I think that's also, people are having to unwind, get less leverage. And I think all these things are factors that are going to push nominal asset values down. And I think that that's what we're watching. And it's happening slowly and it's happening painfully. But, you say, okay, what should I sell? But everything is down 1%, 2%, maybe 3%. No, it'll come back. So you hold on. But basically, it is a time to generally lighten up. And I think that, because I think we're still headed downwards. That's my personal thought.
Interesting. Okay, let's get in some BTST trades as well before we wind up for the day. Naresh, what's on your list?
So taking a long and a short. So first is a buy on Reliance Industries. Stock is showing some bounce back today. Stop loss at 1260, target price of 1310. Sell on MCX, would revise the stop loss at 60 and 40, target price of 6050.
Right. Rudra, what about your BTST ideas?
I'm taking both sell calls. One is a sell on RBL Bank. This has been a weak counter. Even in markets which were doing good, there was no respite or any bounce in RBL Bank. So I will be a seller in RBL Bank, available in futures, looking at target of 150 with a stop loss of 165. And also a sell on M&M Finance. Again, this stock has been a sell on rise kind of a stock, very weak counter. One can look at shorting M&M Finance for a target of 250 with a stop loss of 272. So a sell on RBL and M&M Finance.
Okay, so those are the recommendations coming in. We're just putting the spotlight on the auto sector, and first talk about Hyundai because the numbers came out today and they were weaker than expected. The con call is underway and there's just incremental commentary coming in from the management. They are saying the trend of low single-digit growth is expected to continue. So not high single-digit, but low single-digit is what Hyundai is kind of targeting at this point of time. Current demand moderation is natural, confident of demand recovery in the next few quarters. Macro environment remains challenging, but will focus on strengths and double-digit growth in inquiries and retail in the festival season so far. But going forward for the year, they're expecting a single-digit growth. Red Sea issue is impacting some of the exports, and they did talk about how a couple of launches are lined up in the coming quarters. So just watching out for all of that, but the stock continues to be in the red right now. The other one that we're watching out from the auto space, especially the two-wheelers, of course, ICICI Motor. The numbers are expected tomorrow. It's expected to be a decent set given the kind of numbers we have seen from Bajaj, TVS, etc. We already know the volume figure. The overall Royal Enfield volumes declined by 1% year on year this quarter. Domestic volumes declined 2%, but it was the export volumes that managed to hold one end. Overall, with respect to that, we are expecting a revenue growth of mid-single digits, 7% thereabouts. It's going to be led by increase in realizations and not clearly the volumes, because I talked about how the overall volumes were subdued. Margins are expected to stay steady, maybe 26% thereabouts is what we are expecting. That average selling price or improvement in realization will support the margin at one end. The product mix has also turned better because of more exports and higher value products being sold. But on the other hand, because there were a fresh couple of launches lined up this quarter, the advertisement and promotion spends have gone up. So that's the reason the margins might be a bit limited around 26%. And then overall, we are expecting that for the Royal Enfield business, margin is expected to be stable at 28%. While if you look at the commercial vehicle part of the business, the margins are expected to remain flat quarter on quarter. So that's the picture that we have for ICICI Motors at this point of time. Let's see what they deliver come tomorrow.
Yeah, but more than that, it's going to be the inflation trajectory, which I think shortly will be released. And that's something that the market will definitely be taking cognizance of in terms of the macro data. But we are expecting that inflation, or rather the CPI print for the month of October, is going to hit that 14-month high of 5.8%. We can quickly take it across to Gaurav and get in a snapshot of what to expect. And then, of course, Snehi will join in for the closing trades.
Well, yes, we'll get the official numbers of inflation for the month of October, but when we talk about the expectation, now Street is expecting this number to remain at a 14-month high level to around 5.8%. Now, let's not forget that RBI has put a band on inflation of around 2 to 6%. So, Street is expecting this number to remain at a higher band. Apart from that, the reasons why they are expecting this number to remain high is weak rupee and at the same time rising global commodity prices that we have seen in the month of October. Other than that, when we talk about food inflation, we may see some kind of uptick there as well, because recently government has decided to raise import taxes on edible oil, which can actually push some food inflation even higher to around 9.6% levels. Economists believe that even going ahead, rising intensity of climate risk and at the same time weaker currency is something which we should keep an eye out on, because this can possess another risk for inflation. Other than that, when we talk about core inflation, we may see some uptick there as well. Core inflation could come somewhere near 3.6% because of some core inflation goods like gold and higher gold prices, and at the same time festive season demand could actually push the core inflation. But on the other hand, when we talk about IIP data for the month of September, Street is expecting this to grow at around 2.5% versus what we have seen as a degrowth of around 0.1% in the month of August. And the reason being that when we talk about the macroeconomic data, it seems that the growth is likely to remain positive.
Well, all right, on that note, let's take a look at how the markets have wrapped up in today's trade, and what a somber subdued trading rate's been for us. It's been large cuts coming in across the street. Take a look at what the Nifty is up to, more than a 1% cut coming in. In tandem, you have the Sensex as well. Nifty 285 points lower, 360 points lower from the day's highest point. And if you take a look at Nifty's fall from the day's highest point, it's 1.5% intraday fall coming in. Broader markets also looking rather bleak right now. Nifty mid-cap, Nifty small-cap, both under pressure, and more than 2% cut coming in from the day's highest point, and 1.5% cut coming in on the spot basis right now. If you take a look at what India Wix did, we did see some volatility in the market today. So India Wix was also spiking up slightly in today's trade. If you take a look at the advanced decline ratio as well, very steeply in the favor of the declines today. So that's something that has really weighed on the markets today. But on that note, let's take a look at some sectoral gainers and losers in today's trade. And last I checked, Nifty Realty was the only sector that was holding on to the green. Other than that, you had IT that managed to hold on to the green for the majority of the trading day. But towards the end, it has nominally slipped into the red. That's 0.2% cut coming in on IT as well. But Nifty Realty continues to hold on to slight bit of gains. However, on the flip side, you have Nifty Auto. That's the biggest loser, or in fact, Nifty Realty has also slipped 0.2% into the green. So you have no sectoral gainers today, only sectoral losers coming in. All the sectors under pressure. Nifty Auto being your biggest loser today, followed by the PSU banks, Nifty FMCG, Nifty Metal, Nifty Financial Services, Bank, Pharma, Media, IT. All of these sectors are deeply under pressure. Quickly running you through what weighed on the indices today, you had Britannia. So that earnings con call, the earnings reaction, the stock was 2% lower when it opened, slipped on to much further gain, 7% lower is where it's about to close out on the back of that management commentary coming in. Asian Paints continue to lag. You had L&T Tech, however, that did well on the back of an order win. UPL, Triveni Turbine were in focus on the back of management outlook as well as earnings coming in. NBCC has also received 3 orders, so order win coming in for NBCC as well as RVNL. However, we also were expecting to see some good moves on LIC today on the back of that double upgrade from JP Morgan, but that did not happen, and LIC was also rather subdued in today's trade. But well, yes, to sum it up, it's been a rather bleak session for us. We've reached June lows when it comes to Nifty's intraday move today, and below 24,000, below 23,900 and below 23,850 is where we're ending for the day.